So, what happens when a legendary investor like Warren Buffett plows a massive $726 million bet into America's biggest homebuilder, only to sell the whole thing just a few months later? Well, that's the fascinating story we're going to unpack today, and it all revolves around one company, D.R. Horton. This right here is the central mystery we're trying to solve. I mean, it's a move that had Wall Street scratching their heads, and it gives us the perfect chance to dig in and really understand what separates a good business from a truly great investment. All right, to get to the bottom of this, we've got to start with the company at the heart of it all, D.R. Horton. So, what exactly is this machine we're looking at? Let's just start with scale, because this number is staggering. Over its 45-year history, D.R. Horton has built and delivered over 1 million homes. That's not just big, That's a dominant force that has quite literally shaped the American landscape. And their focus? It is crystal clear. Yeah, they've got these smaller segments in rentals and financial services, but make no mistake, 92% of their business comes down to doing one thing, building and selling single-family homes. They are a pure bet on the U.S. housing market. So we know what they do, but the real question is, how well have they actually been doing it? Let's pull up the evidence. It's time for a 10-year report card. Okay, this table tells such a powerful story. Your eyes probably jump right to revenue, and yeah, it's more than tripled, which is amazing. But the real story here is net income. Look at that. It exploded from about $750 million to nearly $5 billion, all while their debt was actually shrinking. Now that is the sign of a very healthy, very well-run company. And here's what that revenue growth looks like on a chart. You go from just under $11 billion back in 2015 to nearly $37 billion today. Tripling your sales in a decade is just a remarkable expansion in pretty much any industry you can think of. Now, the story for earnings per share, or EPS, is even more explosive. This number just shows how much profit the company is making for each individual share of stock. You can see this absolutely massive peak during the 2022 housing boom. And yeah, it's cooled off a bit since then, but look, it's stabilized at a level that is dramatically higher than it was before. Return on equity, or ROE, is a really important test. It basically measures how efficiently a company is using its shareholders' money to generate profits. Great investors, Buffett included, often look for a consistent ROE above 15%. As you can see, D.R. Horton consistently clears that bar, and in the last few years, they've absolutely smashed it. Okay, so with that strong report card in hand, let's put this company through an even tougher cross-examination. We're going to use a checklist inspired by Buffett's own principles to see if D.R. Horton qualifies as a truly great business. Here's our checklist. It's a four-parter. First, valuation. Is the stock cheap? Second, financial strength. Can it survive a recession? Third, profitability. Is it an efficient money-making machine? And finally, growth and predictability. Is its success going to continue? First up, valuation. The price to earnings, or PE ratio, is a quick way to see if a stock is cheap or expensive. A value investor's benchmark is usually 15 or less. Well, D.R. Horton consistently trades in that 10 to 12 range, so that's a clear pass on test number one. Next up, financial strength, and we'll use the debt-to-equity ratio for this. A conservative benchmark is 0.5. Anything below that is great. Look at this trend. Not only is D.R. Horton well below that level today, but it has systematically cut its debt in half since 2015. That is another big, clear pass. Now, profitability is a little more nuanced. Home building isn't like a software company, right? It has huge costs, land, labor, materials, so it's always going to fall a little short on pure profit margins. However, it absolutely crushes the benchmarks for efficiency, like return on equity and invested capital. The key takeaway here is that they are exceptionally good at turning the capital they have into real profit. So, the company passes most of our tests with flying colors. This brings us to the biggest question of all. What is this business actually worth? Let's move to the verdict and try to estimate its intrinsic value. Intrinsic value sounds kind of fancy, but it's really just a term for what a business is fundamentally worth based on all the cash it's expected to generate for the rest of its life. It's the true north for a value investor, completely separate from the day-to-day noise of the stock market. To figure this out, we'll use a method called discounted cash flow analysis. Now, we're not going to get lost in the math here, but we'll look at three possible futures: a conservative case with zero growth, a nominal case based on its history, and an optimistic one. First, let's look at the conservative case.
Let's say we assume the company's cash flow just stops growing forever, flatlines. Even then, our analysis suggests a value of about $141 per share. You can think of this as the bedrock, the absolute floor for what it might be worth. Okay, now for the nominal case. Let's assume a moderate 10% annual growth, which, by the way, is actually less than its historical average. All of a sudden, the intrinsic value jumps to $232 a share. This suggests that even under pretty reasonable assumptions, the stock could be significantly undervalued. And finally, the optimistic case. What happens if D.R. Horton manages to keep up its powerful growth trajectory? Well, the potential value is staggering, $451 per share. This just goes to show you the incredible power of compounding when you have a really well-run business. Okay, we have gone deep into this business, we've run the numbers. Now let's bring it all home and finally answer that question we started with. This one idea might just be the key to everything. An investor looking at our valuation scenarios could pretty easily conclude that while the market price reflects some growth, it doesn't reflect the company's full potential. And that gap, that space between the current price and its potential value, that's what investors call a margin of safety. So why did Buffett sell so fast? Here's the most likely solution to our mystery. Berkshire Hathaway probably bought the stock when it offered a huge margin of safety. Then the market woke up. The stock shot up 40% in less than 6 months. For an investment that big, walking away with a quick $200 million gain wasn't a sign of weakness in the company. It was just a really smart, opportunistic trade. At the end of the day, this isn't really about D.R. Horton. It's about the process. We just walked through a systematic checklist to understand a business from the inside out. So the real question to leave you with is this: what checklist will you use to understand your next opportunity? And of course, just a reminder, all of this is for educational purposes. Always do your own research before making any investment decisions.